Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. And let's take a look and see what some of the top stories we're following in the BNN Bloomberg newsroom. There are reports the federal government and Alberta have agreed to terms of a deal to support a new oil pipeline to the West Coast. The reports say that federal and provincial leaders are expected to make the announcement on Thursday, along with special exemptions. BC Premier David Eby has been opposing the plan. Eby has said he wants any potential energy deal between Alberta and Ottawa to include a cap or a ban on the use of taxpayers' dollars to build a pipeline. Shares of H&R REIT are getting a lift. The Canadian Real Estate Investment Trust is selling retail and office properties in Canada and the United States, about $1.5 billion worth U.S. H&R says the step is a part of its portfolio strategy. Now, earlier this month, the company ended its strategic review process without a sale. It also reported operating income that missed estimates. It's up right now, about 2.3%, 2.4%. Shares of Zoom Communications are seeing a surge. The video communication company posting revenue that came in above expectations in its most recent quarter, with sales jumping more than 4%. Zoom has been pushing a broader range of products and says it is seeing strong momentum with its AI assistant and AI customer experience suite. It's up about 14% right now. And looking at the markets, you can see TSX into record territory. It's up nearly a full percentage point today, continuing the rally over the last couple of days. And south of the border, everybody in the green down there as well. And nice bounce back for the S&P 500, up 0.66, the Dow up 1.2, and the NASDAQ is in the green now after being in the red most of the morning. It's up 0.3%. Even with the green today, we are seeing mixed markets over the last little while. The TSX, Dow Jones, S&P, WCS crude are all up. NASDAQ was down. It's now up again. WTI crude down. Canadian dollar is declining slightly. So is Bitcoin. There's a lot going on. Let's bring in Art Hogan, Chief Market Strategist at B. Riley Wealth. And Art, thanks very much for joining us.
Thanks so much for having me.
There is a lot going on. A lot seems to be going on during the day, but also for the month. I was surprised to see November's shaping up to be, this may change in the next couple of days, but one of the worst Novembers in 17 years.
Yeah, so November is typically a very good month. And October and September are very typically difficult months. And I think we just pulled forward the seasonality a bit. And October and September actually worked out fine. And some of the concerns about everything that we're thinking about kind of playing out in November. So November actually being down as much as it was coming into this morning was setting up to be one of the worst Novembers in about 17 years. Now, obviously, we got a couple days to make up some ground here, but clearly some of the concerns, clearly focused around AI valuations, focused around will the Fed cut rates in December or not. All of that sort of played into risk-off attitude, and that was really apparent in the first 2 weeks of November, when we had much more significant sell-offs, and last week, where we seemed to have hit the crescendo with the S&P 500 kind of hitting a key level of support at the 50-day moving average and bounced off that nicely. So we were actually down 5% at the low point of the drawdowns here in the month of November, and we seem to have found some support. And the news around AI seems to be migrating for the positive versus that concern, that overarching concern that it had gotten ahead of itself.
Now, does that seem a little firm now, that positivity when it comes to AI, or is it still some turmoil there?
Well, I would tell you this. If you look at the valuations of the top 6 artificial intelligence darlings, or the Mag 6, and if you exclude Tesla from that, because it's not actually an AI play, multiples haven't been this cheap in 2 years. And you're talking about an average 31 multiple for companies that are growing their earnings north of 50%, their revenues north of 60%, and have gross margins north of 65%. So I think the multiples are more rational now than they were a year ago, and certainly don't call into question any type of bubble in the near term. I think the larger concern had been, is there a circular nature to some of the financing of CapEx And those names that were very extreme in terms of on the speculative edge of this artificial intelligence revolution certainly have seen a much larger drawdown. So we're probably in a better place coming into this week. I certainly think that any of the pullback in NVIDIA is probably overdone. I certainly think the fact that Alphabet or Google parent Alphabet is the new leader with its Gemini 3 rollout this week. But I think that leadership is obviously going to evolve over the course of the next couple of years. But in the here and now, it seems like the pole position goes to Alphabet, and that's really driving a lot of the gains today.
And with the news today about chips, does that change anything?
That doesn't really change anything. I mean, NVIDIA has been at the tip of the sword for all of the folks that want to build out large language models. Now, at some point in time, there will be a need for less expensive chips, but we're just not there yet. So I think along the path to this, the dream of agentic artificial intelligence, the folks that want to spend money on chips are going to continue to go to NVIDIA. And after the report last week, we saw that their demand just for next year is measured in the hundreds of billions of dollars, and that's without China. And I would suspect at some point in time, China will be part of that order book, but right now, China is not part of that.
I think sounds like somebody agrees with your strategy there.
I've got two very good analysts that want to voice their opinion on that, and I'd love to get them in the shot right now, but they're right over there begging to go outside and chase some squirrels.
I think I have the same analyst at home as well. Overall, for year to date, I was just looking at some of the numbers. Everybody is talking about tech, but I mean, the communication sector has had quite the year.
Yeah, communication services, part of that Mag 7. More importantly to me, utilities and industrials. This artificial intelligence adjacency, we need all sorts of power. We certainly need data center build out. So when you look at the makeup of 11 sectors in the S&P 500, and you actually have 6 of them outperforming the index itself, much broader than we saw last year.
All right, and talking a little bit to everything. The other thing that everybody, of course, is talking about. There wasn't going to be a rate cut. Now it's changed, and we're heading into the quiet period. What can we expect?
Right. Yeah, I think that the fact that we're going to a quiet period is good. The fact that we've gone from a 40% possibility of a rate cut to an 80% possibility of a rate cut is also positive. It's likely going to be a divided decision, so we may have a 7-5 vote, which is okay. It's a committee. So even if Donald Trump introduces a new, very dovish chairperson before Christmas, remember, you need 7 votes in a 12-voter committee, and this one might come down to a 7-5 vote, but I think the fact that we've moved closer to a decision that perhaps in December we're actually going to see a rate cut, the market is celebrating that.
All right, and GDP growth, we're going to see some numbers again. It's looking at about 1.8%. We were talking up here in Canada, it's almost stagnant. Such a different story down there. What's it shaping up down there with the numbers?
I should probably grab this analyst and put him on the shot right now so we'll stop parking. But I would tell you this. The Atlanta Fed, who estimates this, actually has GDP growth north of 2.5%. So the St. Louis Fed, who also does an estimate, is closer to the mean, which is 1.8%. I think GDP growth is going to pick up in the first quarter and the first half of next year, because a lot of the things that this new administration is bringing about, less regulation and more productivity with artificial intelligence, a corporate tax rate that's going to stay the same as it was for a period of time, haven't really played in because we've been so concerned about trade and tariffs. So I think at the end of the day, we're likely going to see earnings growth next year that is as good or better than we saw this year. And we've had double-digit earnings growth for the last 3 quarters.
And we saw some more earnings coming out today. Alibaba having a good one. Analog devices beats as well.
Yeah, I think that it was amazing. We started this third quarter earnings reporting season thinking we'd have about 7%, maybe 7.5% earnings growth. It's north of 13% right now. The more important piece to me is estimates for the fourth quarter went higher, and estimates for 26 went higher. So earnings growth and the fundamentals are clearly better. Now, around the edges, concerns about trade and tariff are obviously always there. Concerns about valuations and AI reared their ugly head in the month of November. I think in general, if you're an investor thinking about the long term, the fact that the fundamental picture looks sound is probably a good reason to stick with your diversified investment plan.
All right, we're going to leave it there. There's bear markets, bull markets. You might be in a new dog market. Thanks very much for joining us today.
Thank you so much for being patient with the voice.
Oh, it happens. Cheers, Art. Thanks very much. Art Hogan is Chief Market Strategist at B. Riley Wealth. Well, Alimentation Couche-Tard appears to be seeing signs of a bounce back after reporting second quarter earnings today. We'll bring you more with BNN Bloomberg's Lindsay Biscay after the break. À la bonté, Jean Couche-Tard appears to be seeing signs of a bounce back after reporting second quarter earnings today, and the stock price also reflecting that. For more, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks as always for joining us. Some good news for the Canadian company.
Some good news, and as you just said, like the stock price really reflecting that potential good news today. When I just checked a few minutes ago, it was up almost 6%. So good news for Couche-Tard. Beat profit expectations, although revenue was slightly below estimates. But most analysts saying that this is the bounce back that the company kind of needed and is potentially on the road to recovery after that attempted takeover of the company behind 7-Eleven last year. Couche-Tard spent most of 2024 focusing on that. It did not happen. And so now it seems the company is moving on. So for second quarter earnings, net earnings came in at $740.6 million US. That's compared to $708 the previous year. Total merchandise and service revenue was up 6.6% from a year earlier. And the CEO, Alex Miller, says the company also reported same-store sales in Canada of more than 5% and in the U.S. 1.2%, which doesn't sound like a lot, but that's the first increase in 7 quarters. So finally starting to see some progress there. And apparently a lot of that growth was also in the food service section of Couche-Tard. That's according to the CEO, once again, Alex Miller. He said he's never had this much confidence when it comes to a company's food service journey. And the company saw an increase in hot food sales in particular, also through a partnership they have with a celebrity chef right now. So that's really where we're seeing that increase is apparently in food sales. Okay.
And now we talked about the 7-Eleven fail that didn't go through. But are they looking at any other acquisitions? What's out there for them?
There could potentially be some small ones in the near future. Actually, Couche-Tard has had many acquisitions throughout the years. In the last 20 years, they've had 75 acquisitions. About 70% of their stores are made up of acquisitions that they've made. But I know you were speaking with Peter Hodgson earlier today at I2I Capital Management, and he was talking about some of these acquisitions. Obviously, a lot of people would have liked to see that big one with 7-Eleven go through last year. I'm sure Couche-Tard would have liked to see that. And Peter Hodgson was saying he really does want to see some other larger acquisitions, but they're harder to come by. So he was talking a little bit more about what Couche-Tard should be looking at in that respect, and here's what he had to say.
Okay.
Of course, they tried to buy a big grocery store chain in France a few years ago. I wouldn't want to see them do like a giant deal, but they absolutely know the retail environment. They know the customers, they know the locations, they know the geographies. So they could certainly do a small tuck-in acquisition and just run it as a retail store. And sort of have some cross promotions and things like that. I think that would work very, very well. And then just regular tuck-in acquisitions on the convenience store. And obviously the locations can be very helpful if they ever sort of shift to a massive EV charging operation, which I think is perhaps one of the steps they need to take a little bit more aggressively.
Feels like it, yeah.
Yeah, because they have the absolute locations. They just have to utilize those a little bit better.
So also interesting to note, Couche-Tard raised its dividend 10%. It raised it by 10%. It's always been quite low, so now that dividend at 1.2%. The company also bought back almost $900 million worth of stock so far this year. So Hodgson was talking about that earlier, saying, you know, this acquisition didn't go through last year, but at the same time, the company is really using its free cash flow to do other things instead.
All right. Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. Well, a Canadian research company has a promising drug that could offer a new treatment for MS, a disease that affects almost 90,000 people in the country. But the drug faced huge barriers getting to patients, not in the science, but on the stock market. In a 3-part series, W5's John Woodward looks into a case of alleged stock manipulation.
Ahoy, shipmates!
Alexander Barr created this adventure cartoon. He's an award-winning animator.
When I was a kid growing up and watching cartoons, it was really my happy place.
Barr works mostly from his desk in Burlington, Ontario. He's less mobile than he used to be thanks to a diagnosis of multiple sclerosis.
It sounds like it's a significant impact on your life.
Oh yeah, it has a huge impact. Day by day, I have to be very resilient to push through the pain of doing simple chores that everyone else takes for granted.
The disease attacks his nerves, so his muscles don't properly help his blood return from his legs. Barr uses this device to combat some MS symptoms.
It basically inflates my feet, my calves, my thighs, and then it'll just keep going. So basically, it's kind of replicating circulation.
MS is a progressive disease. There is no cure.
Hope makes you positive. You know, it's the hope that there will be a solution.
And one day, hope came in the form of this video.
Characterized by flaccid tail and completely paralyzed hind limbs.
That's a mouse whose nerves had been artificially damaged, just like with MS. Then, after 42 days of treatment, the mouse regained the use of its limbs.
After a couple more days, the mouse appears to recover completely.
The drug it took was called Lucid MS from a company called Quantum Biopharma, based in Toronto.
Watching that video must have been an inspiration.
It was incredible.
That mouse video got a lot of people's attention, including investors like Atul Dadwal.
How much money did you invest in total?
A few $100,000.
$300,000, a lot for the owner of a Toronto restaurant franchise. But as Lucid MS moved through the stages of clinical trials, the opposite happened. According to Quantum's documents, in June 2020, as favorable test results came in for another drug in its portfolio, its stock price dropped from $7.39 to $2.76. As it received regulatory clearance to proceed with clinical trials of Lucid MS, its stock dropped from $1.84 to $1.56. The crash continued, and soon Dadwal says he lost 98% of his investment.
It just kills you. There's no way. It buries you 98% down in the earth. So it cannot come back and see the light of day ever again.
Did it have other impacts in your life?
Of course. I mean, you lose your health. Your health is not the same anymore.
Did that make sense to you, knowing that they are looking at a very promising technology, but the shares are somehow dropping?
There appears to be something very wrong.
Alex Barr had believed in the product so much he joined the company's board. He said the low share price sent the company into a tailspin.
And as a result of that, it means that it's much harder to raise money. And if they can't raise money, they can't do the trials to prove that the research works for people like me. And that drug will never become accessible to people who need it.
A situation Quantum Biopharma couldn't accept. They believed there was another reason their stocks were collapsing and started their own investigation, an investigation that would spark a nearly $750 million lawsuit.
And that was part one of W5's John Woodward's report. Up next, we'll tell you why the Japanese government has proposed an economic stimulus package that is raising concerns regarding the country's fiscal sustainability. Japan has announced a new $1 trillion stimulus package designed to provide price relief and economic support for the country. However, this initiative could have wider implications for the global economy. For more on it, we were joined earlier by Thomas Urano, Co-Chief Investment Officer and Managing Partner at Sage Advisory.
We've had for decades a scenario where funding costs, i.e. interest rates in Japan, have been demonstrably lower than the rest of the world, right? Which made it attractive for international investors to borrow yen or fund in yen and turn around and move those dollars or those yen into other markets around the globe, either in higher yielding or higher returning assets, whether that be fixed income or risk assets. So it's been a scenario where Japan has been able to export capital to the rest of the world. And that capital, of course, found its home in various asset markets. However, as we've seen over the last several years, the yield in Japan, interest rates in Japan have been rising substantially. 10-year JGBs have risen 7x since the fourth quarter of 22. They've gone from 25 basis points to now 1.8%. And the problem with that is, as you include your FX hedge costs into that, suddenly the interest rate differentials make it less attractive or unprofitable even to move assets out of yen or fund in yen and invest overseas.
So this could dry up liquidity or a source of funding that investors and speculators have used for decades?
Sure. So as those funds have moved out of Japan into the rest of the world, if the dynamics of those economics shift, meaning rising JGB yields increase the borrowing costs or make it more attractive for institutional investors in Japan to bring that money home, i.e. repatriate those dollars back into yen, that's going to be some headwinds, right? That's going to be a draw on capital from foreign markets back into Japan's market.
So there's a double whammy here. Then money could be drawn back to Japan to buy domestic money to buy their local bonds, but also there could be a source of funding cut off for the global market.
Sure, right, and that's exactly the risk here that's occurring, right? If this happens in size, and those differentials in funding versus yields abroad, if they become significant enough to motivate investors to move money back towards yen, what does that look like? That could be headwinds for yields abroad, right? As some of those investors have been borrowing in yen and investing in sovereign domestic markets, U.S. yields, European yields, emerging market debt. If that money leaves, it could be a headwind for yields in those markets. It would add FX volatility as you start to think about unwinding hedges and move from foreign markets back to yen. And then I think that would just, in general, be a headwind as a liquidity drain on markets globally.
That's interesting, isn't it? I wonder, could that be, I mean, who knows? It was the failure of an obscure Austrian bank that helped to spark the global depression in the 30s. I wonder, could this be a catalyst?
Sure. I'm not saying that we're going to have a depression, right? No. But I would say one of the tailwinds that's been occurring for decades because of the interest rate differentials in Japan versus the rest of the world has been Japan has been a large exporter of liquidity, right? And maybe that tailwind is drying up. There's been a significant, I'll say, rewriting of yield differentials between Japan and the rest of the world. And if that's the case, then fund flows back towards Japan, or at least a lack of additional flows from Japan into foreign markets, again, could be a headwind for liquidity going forward.
And Japan, it seems like forever, since at least 1989, when I think the previous peak for their market was, it's just had this moribund growth. This new leader in Japan determined to juice that?
Sure. I think if you look at Japanese equities, what are they responding to? Well, on the one hand, a $135 billion stimulus package designed to support GDP growth, which has been lagging in Japan, right? So what are they talking about doing? This is the largest package since the pandemic. They're talking about providing energy subsidies, tax cuts, some handouts, basically anything they can to support direct consumption in Japan and GDP growth in Japan. So a positive aspect, to be sure, but also consider the concept too that if there's this repatriation effort, what does that look like? That means some dollars moving back to Japan that can also be supportive for capital markets in Japan.
It is fascinating that I do remember, I think this was prior to the housing crisis, though. People in markets like Hungary were borrowing money at low Japanese interest rates and buying real estate. So this has been going on for a long time, this cheap Japanese funding.
Sure. Yeah. Like I said, Japan has been a funding currency for decades. The fact that differential is changing, I think it's just something investors need to pay attention to, right? If it's a scenario where, funding in local markets in Japan is going to dry up liquidity and depress investment demand for opportunities in foreign markets, it's certainly a headwind for capital appreciation in those assets.
And what about Japan itself? Can you generalize, is the equity market there looking like good value?
I can only say that I think in terms of Japan on the equity side, you have to respond to what the growth picture looks like there. Right? They've been struggling, right? There's a reason the new prime minister is coming on board. There's a reason she's proposing a very substantial stimulus package. Their GDP growth has been weak. It's been sub 1%. For third quarter of this year, it was actually in contraction, down about 40 basis points. So, thinking about equity growth or equities in Japan, I think you have to think about what's the outlook for obviously domestic growth in Japan, but then also, there's some hope involved here that the stimulus package will help drive growth back into positive territory. Targets or estimates are somewhere near 1.25%, maybe 1.5% for 2025. And perhaps the stimulus package could push it a little higher than that.
And Andy was speaking with Thomas Urano, Co-Chief Investment Officer and Managing Partner at Sage Advisory. After the break, we'll bring you today's top headlines from the BNN Newsroom. Shares of Alimentation Couche-Tard are trading higher after the Canadian convenience store operator posted profits that topped estimates in its latest quarter. It's up 4.5% right now. Revenue in its Canadian and U.S. merchandise segments also beat expectations. The Circle K owner says the quarter was also boosted by acquisitions despite lower fuel prices and wholesale fuel revenue. Shares of NVIDIA are seeing some pressure today after a report from The Information that Meta Platforms is in talks to use Google's AI chips in its data centers. According to the report, Meta plans to implement the chips by 2027 and may also rent chips from Google's cloud division next year. Investors believe a deal would signal growing momentum for Google's chips and create a long-term potential to challenge NVIDIA's market dominance. Shares of Abercrombie & Fitch are surging. The apparel retailer beat on the top and bottom line in its third quarter. It's up 35% right now. All that was driven by better sales in its Hollister brand as well as higher margins. The company also raised the low end of its 2026 sales and profit targets. Abercrombie says the quarter was also helped by its pullback on promotions and an improvement in prices. And another good day for the TSX, up over into record territory right now, 30,920. It's up 1% for the day. South of the border, everybody's in the green down there right now, quite solidly too. S&P 500 by 0.75%, the Dow by 1.2%, and the Nasdaq by nearly 0.5 point. BC Premier David Eby is speaking out about the potential pipeline deal in Alberta. The Alberta government is expected to sign a memorandum of understanding with Ottawa for resource development this week. For more on it, we're joined by CTV's Colton Prale. And Colton, thanks as always for joining us. Now, the BC Premier has said he wants BC at the table for planning of any potential pipeline in his province. So what are some of the concerns? Is he sharing it?
He is. The big one was not being involved in the conversation. He spoke with the Prime Minister on Monday where he referred to learning about this pipeline and potential MOU proposal that we are expecting to come on Thursday, although it's worth pointing out sources say that date is not entirely finalized. Eby says he learned about that in the media, and so he was outraged that he was not involved in those conversations about a potential pipeline that would cross BC territory. On top of that, he had a few points that he wanted to highlight. First, the need for support from coastal First Nations, which we should point out at this point in time oppose the proposed pipeline. Secondly, he wanted to ensure that no taxpayer dollars were used in the construction of a potential pipeline. And if they were, that there were a cap on those taxpayer dollars. And if there was no cap, then at the very least, BC would have $50 billion of taxpayer money to put their major projects forward. It was a number of issues that the BC Premier took with Mark Carney, asked about the reception from the Prime Minister. He said it was muted, that Carney didn't give anything away, but did listen to the BC Premier. He also highlighted his concern to the Prime Minister that in moving forward a pipeline to the northwest coast of BC, and especially in changing potentially the tanker ban in the Hecate Strait and off the northern coast of BC, it could jeopardize some of the major projects already being focused on by the MPO for British Columbia, specifically implying especially that electric transmission line to the Yukon could be in jeopardy as a result of this. As far as the MOU itself, it's worth pointing out that at this point in time, still not finalized, expecting it to come out Thursday, and it does go beyond pipelines. While we are told this will push forward that pipeline project and potential proposal that we expect to come from Alberta in 2026. Also look for larger energy changes in this. Things like the emissions cap, the industrial carbon pricing system as well, potentially a bit of a roadmap when it comes to the implementation of the Pathways carbon capture project that the Prime Minister has hinted his future green plan is essentially contingent on. Really look at this as a way to skirt some of those Trudeau-era environmental policies without necessarily taking them off the books altogether. It's going to be much more significant, and it appears as though the federal government, and from what we are being told by sources, this is them setting the stage to clear up the regulatory environment a little bit to try to incentivize some of that private capital that will be needed for a pipeline project.
Okay, now, and Energy and Natural Resources Minister Tim Hodgson was pressed about that removal of the tanker ban in the House of Commons Committee on Monday. What do we know about it, and what do we hear from him?
Yeah, his comments were really interesting. He wouldn't specify exactly what they were going to do with the tanker ban, but he did say generally, when it comes to these major projects, the office will do whatever they can to remove barriers. But crucially, and he caveated that with removing those barriers was dependent on support from First Nations and jurisdictions. So while we are told that this is likely going to necessitate some kind of tanker ban carve-out, the Natural Resources Minister implying that it would also require some sort of collaboration with those impacted.
All right, and we expect to hear more likely on Thursday of this. We're almost out of time, but likely Thursday?
Likely Thursday. Mr. Carney's supposed to speak at the Calgary Chamber of Commerce. That is the date circled, but as mentioned, potentially could move.
Okay. Colton, thank you for that. CTV's
Anytime.
Colton Preo. Coming up, Hot Picks. We'll look at 3 plays in transportation and logistics after this. Time now for Hot Picks. We were joined earlier by Jason Saddle, analyst transportation and logistics at TD Cowen, to discuss 3 plays in transportation and logistics. We kick things off with FedEx as his top pick, a company he thinks is positioned to benefit from growth in e-commerce.
FedEx right now, when you look at the where it's trading at roughly in line with its historic average. But remember, the company is going to be breaking out its LTL division for investors. So we're really looking at this thing as a sum of the parts, because your LTL business tends to trade at a much higher multiple than does your parcel portion. Near term, don't expect a lot out of FedEx or even UPS when you're looking at the parcel guys. Peak season expectations, I'd say, are somewhat muted. Your business from your larger customers is probably in line with historical trends in terms of your peak season expectations, where your SMBs are a little bit more muted. In other words, people that probably can't shift as much with the changes in the tariffs and everything else. But the good news is that both FedEx and UPS are remaining very, very disciplined on pricing. Now, you can't overlook a recent tragedy with that UPS had with one of its freighters. The MD-11s are grounded for both carriers right now. It's a workhorse for a lot of them, but it's not a large percentage of either of their fleets. FedEx, it's actually a little bit smaller. It's about 4% versus 9% at UPS. We're expecting these guys to really just sort of shift a little bit more to the ground, maybe deploy some extra spare aircraft and adjust some of the maintenance schedules going forward, and even probably take advantage of some of the belly space of some of the consumer airlines that are out there. Longer term, when you look at FedEx, one of the things I think that excites investors is really looking at the changes that they have in their network that is coming, because most people don't remember that FedEx was actually created by just an air network, and then they added the ground later. So they're really going to be right-sizing their network going forward. Instead of having 2 FedEx trucks stop at your house, they're going to try to go to 1 in as many places as possible.
Right. So that was that deadly plane crash in Kentucky, forcing UPS and FedEx to ground their fleet. Yeah, 14 people killed in that one. GXO Logistics, remind us what they're all about and what attracts you there, Jason, please.
Sure. So, when you look at GXO, they're basically an automated warehouse provider and really a supply chain coordinator. When you look at automation in the transportation space, a lot's focused on automated trucks and sort of that's on the come, but it's been on the come for many years right now. There's also automated talk on the rail side, but there's a lot of pushback there as well. There's really no pushback on the warehousing front, and this is where they play. There's a new CEO that came in recently, Patrick Kelleher. He's come over from DHL, very well respected in the supply chain. He's refocusing the company on sort of organic growth and expanding into some areas that tend to be a little bit higher margin. But the really interesting thing about these guys is they tend to lock up long-term contracts, and the renewal rate on these contracts are in the 90+% range. When you look at what they've locked up for 2026 through the third quarter, it's almost where we're expecting them to grow all in. So they've got a lot of their growth already locked in. We suspect when they report 4Q, they'll have almost $1 billion in revenue booked for 2026 in new contracts. So there's an exciting story there, and also a recent acquisition that they did, Wincanton, that was held up by the British regulators, is set to pay some dividends right now. So it was held up, so they really couldn't take advantage of some of the cost savings. We expect that to flow through about $60 million for their EBITDA. And then on top of that, we expect that to allow them to expand more into the A&D consumer base, which should position the company in the years to come.
And then finally, Knight Swift Transportation, KNX in New York. What's distinctive about them, Jason?
Yeah, well, I'll start off by saying in the U.S. trucking space, things are bad. So that's there's no way to get around this right now. But really, and we've been in the downturn, by the way, for over 3 years, the longest I've seen in my 30-plus year career in logistics. That's the bad news. The good news is we're starting to see ways capacity can come out of the marketplace. And a lot of that has been driven by the government. So the FMCSA, which is under the DOT, has issued several rulings. The biggest one out there is the non-domiciled driver ruling. And we estimate that can impact roughly 8% of the capacity over a 2-year period of time. Now, that's stayed in the courts right now. We expect that stayed probably be lifted or maybe sent back to the FMCSA. But that's a lot of capacity to take out of the marketplace, which should, all other things being equal, help pricing. You add on top of that some English language proficiency testing that should take some drivers out of the marketplace, as well as illegally issued CDLs, commercial driver's licenses. Those things will be taking capacity out. Recently, California was hit with 17,000 taken out of the marketplace. That's almost 9% of their CDL capacity. Now, mind you, maybe not all of those were active, but still, this is a way to take that capacity out of the marketplace and provide some much needed help to the U.S. trucking industry, which has been really sort of under the thumb of lower pricing for the better part of, like I said, 3 years.
And just what went on with those driving licenses? There was fraud in the system?
Well, unfortunately, there's been a lot of fraud in the system. I mean, you have what they call CDL mills, which will get you your CDL in 1 day. Think about that. You can get a driver's license to drive an 80,000-pound vehicle in 1 day. There's a lot of issues right now that they're looking to correct, and a lot of it is around safety. So I know there's, a lot of it's been politicized, unfortunately, but when you look at the things that they're doing, the focus is on safety, and that makes a lot of sense.
And is this kind of fraud happening in Canada as well? Can you give us any color on that?
Yeah, and Canada's had some issues too with some of the some illegal drivers coming up, sort of setting up shop and then closing down really quickly and moving around. They have their issues as well. So it's not just the U.S. I don't want to paint such a bleak picture for my home country, but it is an absolute problem. And on top of that, you have violations of the cabotage rule, right? Like, so when you're looking at drivers that are supposed to, come in, let's say from Mexico and drop off a load and then go back, they're not allowed to solicit other business once they're in the U.S. And I believe typically they have about 7 days to do so. You're finding a lot of these drivers are staying up to 20 plus days in the country and are probably soliciting other work. So there's a lot of stuff that they're looking at right now to curtail that capacity that's expanded so much sort of post the COVID supply chain situation.
And he was speaking with Jason Saddle, analyst transportation and logistics at TD Cowen. Tensions between Canada and the U.S. are causing many snowbirds to opt out of heading stateside this winter. We'll have more on that after the break. Tensions between Canada and the U.S. are causing many snowbirds to opt out of heading stateside this winter, and it could even affect travel for American Thanksgiving this week. CTV's John Venevali-Rao filed this report.
At Toronto's Pearson Airport, this is typically a busy week for U.S. travel, with American Thanksgiving on Thursday. But this year, the lines may not be as long as usual.
I try my best not to go to the States right now. The whole country's in a conflict.
I am not going to the U.S. at all.
Many travelers continuing to boycott travel stateside since relations with our neighbors remain strained. Something brought up by several American senators from border states over the weekend as they attended an international security conference in Halifax. Some calling Trump's tariffs a mistake, noting not only the economic damage, but how Canadians are responding personally.
But the deeper problem is the cultural break. The idea that Canadians now don't think of Americans as their friends and their neighbors, but as an adversary.
We're your friends, and we're going to do everything we can to put things back to the wonderful relationship that we've always had with Canada.
The troubled state of that relationship reflected in the latest travel data, showing in October return trips by car from the U.S. were down 30% compared to a year ago, and by air they fell 24%. We caught up with Brian Ireland as he headed off on a holiday to Cuba. He says this year he didn't even consider going to Florida.
Not at all. Not at all. We just try to stay clear there right now. We're not involved in the politics, and we're happy to be a Canadian.
A recent poll found 70% said they'd feel uncomfortable traveling to the U.S. this winter. 65% said they were concerned about new border requirements for long-term visitors, including fingerprinting. Still, some of those U.S. senators remain optimistic the damage to relations can eventually be repaired, with one of them, an independent, simply calling the tariffs ridiculous. John Benavelli-Rouse, CTV News, Toronto.
As holiday shopping ramps up, downtown districts across Canada are trying to keep spending close to home. Some are offering discounts on local gift cards as an incentive to pull people in. CTV's Maria Saru has more.
On Charlottetown's main streets, the search for the right gifts for loved ones has started.
Family, friends, neighbors.
And as costs climb, shoppers say they're being more intentional about where their dollars go.
Definitely supporting your local artists and your local community. It's so important for our economy.
Making sure that we support our friends, family, community, our country, our pride.
This week, Islanders and businesses got an extra boost. Local gift cards offered by Downtown Charlottetown Incorporated were 20% off, a one-day deal to promote spending at shops in the community.
If it benefits a business, it benefits the community. It means that there's more attendance at events. It means that there's more tax base for social programs.
140 plus stores and restaurants are participating, and Charlottetown is one of more than 40 cities across Canada that have joined the Downtown Gift Card program. The aim is to drive some sales away from massive online retailers into small independent businesses. Owners say every customer coming through the door counts.
With the trade negotiations, with tariffs, we've seen a real surge of people finding it important to support local, shop local.
For stores on this street and beyond, a holiday shopper today could be a return customer tomorrow, and that can make a real difference. Maria Saru, CTV News, Charlottetown.
All right, let's take a look at the markets before we head to our last break. And you can see the TSX, it is closing in on the intraday high, about 18 points off. We'll say 19 points right now, but it's above 30,900, up nearly 1% for the day. And it's being led by a few different companies here, but let's take a look at the ones that are having a good day, shall we say. We've got BRP, and that is up 7.71%. That's the one we were talking about last Friday, actually. It designs, develops, manufactures recreational vehicles. So apparently people are having a good time. I'm going to buy some nice Christmas gifts right now. You can see BRP is up. Discovery Silver also up 4.82%. IM Gold, a lot of the mining sector having good days right now. And of course, the other one having a good day today is Alimentation Couche-Tard. We were talking about it, their earnings. They had a beat. And you can see it is up, trying to recover for the year, but right now it is up 4.3%, but still down 5.85 though for the year. And south of the border, one of the ones we were looking at, of course, is let's talk about some of the losers quick before we go. Calta Exploration off by 5, Parex Resources down by 4, and Vermilion Energy off by 3%. South of the border, Nvidia is having a bit of a hit because of all the chip talk that's going on. That wraps up this edition of Trading Day. I'm Roger Peterson. Thanks for joining us. Have a great day.